Welcome to Macro Hive Conversations with Bilal Hafiz. Macro Hive helps educate investors and provide investment insights for all markets from crypto to equities to bonds. For our latest views, visit macrohive.com.
Greetings and welcome, Mustafa. I've been really looking forward to this podcast, so welcome to the show.
Thanks, Bilal. Happy to be here. I've been a big follower of your podcast for a while, and I see this is a great opportunity for me to be part of this.
Great.
Again.
And as you well know, that we have this tradition where I like to ask the origin story of my guests. So can you tell me something about, where you studied, what you studied at university? Was it inevitable you went into finance, and something about your career up until this point?
Sure. My introduction to finance as we know it was in my graduate school at University of California in San Diego. I started out, I always wanted to be an economist for a long time. I started out in graduate school with the aspiration to be an econometrician. And so I went to the most as mathematical and data-oriented graduate school as I could imagine at that time, and did my PhD in economics under two. I was lucky to have two Nobel laureates as co-chairs of my dissertation. One was Robert Engel, the other is was late Clive Granger.
As in Granger causality.
Yes. So Granger introduced the concept of causality in econometrics. Before that, it was mostly about associations rather than causality. So his contribution, was like, and Engel introduced the concept of the Dutch models. And between the two of them together, they have many, many new ideas and concepts in econometrics. So I started working with them, and both of them. And while I was working on my PhD, mostly on the topics that was hot at that time, various types of time-varying parameter models in time series. There was a crash in the stock market in '87, well known as the Black Monday at that time. And suddenly I got very interested in finance, in options, because eventually it was clear that the whole crash happened because of what was known in those days as portfolio insurance, which is basically the replicating optionality with dynamic hedging. And the crash was just a proof that the replicating portfolios doesn't always work, especially when tail events happen. So I got very interested in that. I got very interested in options modeling, options pricing, implied vols, and eventually did a PhD dissertation that was implied volatility, sort of statistical models of implied volatility, and with both supervised by both Rob Engel and Clive Granger. So that brought me from pure econometrics to finance, and my interest in finance, interest in options pricing and volatility, etc., remained for the rest of my career. So after I left graduate school, I took a job as a assistant professor in the finance department at Louisiana State University, otherwise known as LSU in the world of basketball and football. So I taught for a few years options and futures courses and investment courses. In those days, there was a lot of innovation. That was probably the peak innovation decade in finance, especially options pricing and asset pricing theories. So the Black-Scholes had just come up with their models about 10 years before, and there was a lot of improvisations going on. in those modeling. And so I spent a few years teaching, and then thought actual working on something that's actual investing or making decisions involving options would be more interesting. So I moved from teaching to Freddie Mac, which is one of the two GSEs that hold very large mortgage portfolios in the United States, in the world, actually. At Freddie Mac, it's all about optionality in the Freddie Mac's and Fannie Mae's business, which is basically they hold a very large portfolio of mortgages and split out the credit portion, which goes into the credit risk management of the portfolio, and then the interest rate portion of it, which is basically a gigantic short option, a short position, option position, a leverage short position in options. So my job, I spent about a decade.
And just as an aside there, the reason that's an option position is because people can prepay their mortgage. And so
Exactly.
if you're a holder of a mortgage, like Freddie Mac was, you're never quite sure when somebody's going to prepay their mortgage, and suddenly you had hedged, you had put on investments to manage the interest rate risk, and suddenly that hedge, that position's gone, but you still have the hedge, so you have to suddenly decide what to do with that.
Exactly. So the homeowners who are taking on the mortgage can refinance, and that changes the whole characteristics of the cash flows. So if you think about a typical mortgage in the United States, which is a 30-year maturity, if it's never prepaid, you can have duration as long as 15, 16, 17 years. But a mortgage can also refinance in a matter of months since after it's originated, and you get a duration of like 4 months. So you can have the same financial contract that can swing between a duration of 15 years to a duration of 6 months just because of simple changes in interest rates. So that's known as negative convexity of a mortgage portfolio. So whenever you have an option position, it's if you are short the optionality, you are negatively convex, and if you are long the optionality, you are positively convex. And what Freddie Mac was, and similarly with Fannie Mae, those two were sort of unique in this, was a huge short position in a hugely negative convex bond position. So my job was to hedge, manage that convexity aspect of that mortgage portfolio. Basically, over time, as interest rate changes, the duration of the portfolio changes, and you do delta hedging to keep the duration in the same place. So the problem was, this is a gigantic portfolio. The Freddie Mac's portfolio, when I started, was about $200 billion, and when I left 10 years later, was about $650 billion. And so given that it's a gigantic portfolio, delta hedging a portfolio of that size also means massive trades in either buying bonds or selling bonds, or receiving in swaps or paying in swaps. And sometimes it wasn't, it was all, this is all improvisation. And I feel very lucky to be in that position to learn and improvise in that whole, improvise this whole hedging MBS. That was the peak decade of how much influence the MBS market had on the rest of the bond markets. So learning number one, that you can't really delta hedge a portfolio of this size, because not only it's very negatively convex, as I said, the duration could be at 15-year or 6 months in a matter of few weeks. It could change. but also the leverage of these GSEs was monumental. These days, 10-to-1 leverage hedge fund, we think is very risky. The typical GSE was about 40-to-1 leverage on a book value basis. And sometimes the mark-to-market leverage could be 100-to-1. So you got a massively leveraged portfolio that has negative convexity. So the combination of negative convexity and leverage created huge movements in the market just as the portfolio swings a little bit. It's like if you move the Titanic a little bit, it creates a huge wake around the whole system. So one thing that I feel very lucky to have that opportunity to improvise on a lot of that. That instead of delta hedging, introduced more optionality on the hedging side. And that's one of the reasons that the swaptions were introduced. I was one of the first people that started using swaptions to hedge a leveraged mortgage portfolio from my desk from my hedging desk at Freddie Mac. So, and then there was this, my academic knowledge on that field, and the difference between the practical application was huge. What is the strike price of a mortgage portfolio? What's the maturity of the mortgage portfolio? You don't know any of that. So you do trial and error. And eventually, my thought was maybe about 100 basis point. The mortgages used to be in the late 90s, about 6.5 average coupon. Yes, about 6.5, 6.5, 7s in terms of average coupon in those days. It's coming back there, but we're sort of cycles in a funny way. But so what strike, and these, firstly, as I started using swaptions, the big experiment was the strike. And as you trial and error and see, because there's no mathematical model that will tell you.
And just to be clear, just for our audience, the swaption is simply an option on an interest rate contract, on a swap. So swap's the type of interest rate contract. And the strike is the price or the level at which the option would be in the money.
Correct. So a fair swaption would be a right to pay fixed. A strike would be the interest rate which you would have the right to pay fixed.
Yeah.
So if you believe that the interest rates are going up, then you do a swaption where you would have a right to pay fixed. If you have a belief that interest rates are going down, or you have exposure to lower interest rates, then you have the right to receive fixed. So my conclusion was that if I include a lot of low strike, right to receive fixed in the portfolio, because of the inefficiency of homeowners in refinancing, eventually by the time they refinance in large numbers, it won't be until another 100 basis points or more in interest rate decline. So it makes sense to buy low strike optionality. So then I started introducing, and they had buy-in from the top management of the institution that makes more sense instead of delta hedging a gigantic portfolio like that. So added billions. Initially, it was a big learning process for the vol market, fixed income vol market at that time, because Q was more of a theoretical concept rather than actual practical. Now that the GSEs started buying SKU, a SKU, it basically means not buying an optionality that is not at the money or at the current interest rate, but at a lower interest rate or a higher interest rate. So the demand for this SKU started going up in the financial system in the US, and before the market was even clear about it, because it's a portfolio of to $600 billion, the amount of optionality that had to be bought was also like hundreds of billions of dollars in notional. So the nice thing about 90s, because skew was not understood very well, it was mostly priced you pay 100 basis point higher in vol for 100 basis point out of the money optionality. And it wouldn't fluctuate much. So that was one of my huge transition from understanding academic optionality in my PhD work and my teaching days to actually I would use the word load up on skew in the option market in the US.
So you were really there during the beginnings of the swaptions market as it was developing. You started it, yeah. And then also at the same time, you recognized and saw that there was skew in the market, which in theory shouldn't really exist, I suppose. At least with Black-Scholes, it would be a symmetric. It would be a symmetric level of vol on either side of the strike or at the money strike.
Yeah. The market was smart enough by that time, by the 90s, that there should be a lower strike should be higher priced. But market had no idea how much higher price should this be. So as GSEs went and paid only 100 basis point higher, it wasn't high enough. And the whole street would think of this as an arbitrage opportunity by constantly selling skew to the GSEs, especially Freddie Mac. And fine. So the biggest test was eventually after the dot-com bubble burst. If you remember it, there was a sudden big collapse in the stock market and interest rates started falling very fast. So in a month, there was a massive decline in interest rate in 2001, few months after the dot-com crash. And suddenly the 6.5 mortgage portfolio became very in the money, and all the swaptions, like $500+ billion of notional, became in the money when they were statistically supposed to be very out of the money, given the volatility of interest rates in those days. In volatility of interest rate was very low in those days, the realized volatility. And so sudden increase, the swaption book suddenly had a profit mark-to-market of $5 billion+, and it shocked the whole system in terms of how much losses the other side had to take because all this skew being sold to the GSEs. And then, so there was for me, it was a huge proof of concept where how do you hedge the negative convexity of a mortgage portfolio that is highly leveraged. But then the story goes on, and I can continue with that. But there was a huge gain, and then the management had to deal with the gain, and there's a whole different story how the management dealt with the gain. But the learning process was that the negative convexity of the mortgages to manage it required a pretty a huge amount. It's just a theoretical understanding of optionality doesn't give you that. It's a huge trial and error. But since then, interest rates pretty much either declined or stayed stable. And so the MBS universe has become more and more lower coupon and the convexity lower and lower. So the hedging with options have declined over time. And I also left GSEs after this massive outcome of the hedging and moved to the sell side on the street. But that was the story of the massive swaption beginning of the swaption market, beginning of the huge, the total repricing of skew.
And I want to cut back to that, to today's world. But before we do that, just to finish up your career your career path, you then went to work for Deutsche, running rates research there for a period of time. And, what was the big learning during that period? Because now you were managing risk in the previous, you went from academia theory to practice of managing, options risk. And then you went to the sell side, which is the kind of the other side of the fence, so to speak, in terms of financial institutions. What was the learning there?
Correct. So that was the story of my life. Several years of theory and then years of practice, then go back to years of research and then go back to practice. I had this, that's been the story for years. So then when I went to Deutsche, the timing was really interesting to be in the Deutsche Bank trading floor as the head of rates and agency MBS research, just leading up to the GFC, the subprime crisis, and right after that. And but from a research and client point of view, some key things were first, clients. A few of them were seeing some of the. I'll just give you some anecdotes. The one of them was the whole ABX index and how that was created by the mostly by the non-agency mortgage desk and the non-agency research guys. But I spent a lot of time with the same team as the rates person working next to them. So see the whole thing evolve. Eventually, there was a movie, there was a book, all of that. But I saw that movie in real life in front of me, making client presentations on part of the client presentations in ABX, of ABX index.
ABX is asset-backed index, which basically was an index that held a basket of asset-backed securities on there. And that was probably a really important step into the transparency for the market, because before that point, you had all of these asset-backed securities. Often the asset were mortgages, or subprime mortgages, I suppose, and just other assets within there. But it was opaque, and suddenly this index got created, which was, I guess, was it 06, 07? Was that the time?
Yes, 06, 07.
Yeah, and then suddenly people saw, were able to see a price for the aggregate.
Yeah,
sort of market.
Exactly. Before that, it was not possible to short housing in the US.
Yeah.
There was not a clear instrument, liquid instrument that you could use to short housing. So no matter how much you didn't believe in the fact that home prices were skyrocketing in those years, in 06, 07, and going into 08, you couldn't really do a trade that would short houses. There's no market to short houses. So this allowed a way to short the housing market, and that came from few houses in the street, but Deutsche was key in developing that index and developing. So I spent a lot of time with the research team at Deutsche as the index was developed, making presentations to clients.
And at the time, Greg Lippmann was at Deutsche Bank, who was played by Ryan Gosling in The Big Short, the film.
That's exactly, and the film was very real. Watching the movie, I felt like it was as real as it got at that time, because I saw that movie in real life in front of me. Eugene Shu, who was the research head of the non-agency research, spent a lot of time developing convincing clients to short the mortgage market with this instrument. And I worked very closely with Eugene and that also in presentations to clients as well. So that was one. So later on, watching that in movie and in book was sort of surreal to me. I saw clients that made a lot of money doing that trade, and we have seen clients that did that trade and then unwound it because the negative carry was too high, and missing out on that whole opportunity. So I saw the whole success stories and failures. The other piece that was very interesting in Deutsche days, where we used to have a very good team in New York that covered GSEs, which myself, and we had Mike Mayo, who used to cover the banking system, who also very well-known and really good bank strategist. He was at that time at Deutsche Bank, and then Krishna Memani, who used to do corporate bonds. And three of us would go make presentations to clients about vulnerability of each one of the sectors in the middle of the crisis. I had complete understand. I would give totally transparent picture of how little capital the GSEs have for the amount of volatility that's expected. And a lot of clients would say, no, this is the biggest opportunity to buy. And so there was a lot of disbelief that these gigantic, rock solid institutions are so vulnerable in the United States at that time. So seeing those responses, seeing some believers, some complete disbelief that this rocks like GSEs, the banks that are massive and apparently solid could crumble like house of cards. So that was another piece that, and my Deutsche days, being in the research, I had a better picture than if I were actually running risk at that time. So the timing was very good as well. So so that was the Deutsche experience. So both sides of fixed income, both sides of extreme volatility. It has been a very rewarding career for me. And then I worked again back to risk taking in Voya Financial, which is the new name for ING US, investing in global bond portfolios, as well as other fixed income, also hedging the different kind of convexity, which is the variable annuity insurance type hedging. Both that's also very negatively convex, but different type of negative convexity.
Yeah.
So that's my career. Half of the time on the buy side, half of the time in risk taking, half of the time in doing research.
Right. And now you'll be joining Macro Hive as well. You'll be.
I'm really looking forward to.
Yeah. Now, I did want to talk about markets today, and the big question first is, given everything you've talked about, the mortgages and housing crisis, is there a housing issue today at all in the mortgage market? Because obviously house prices have fallen a lot over the past year or so, but it doesn't feel like we're in the same phase as the subprime crisis. It doesn't seem like the leverage is the same and so on. But so is anything to worry about with housing and mortgages?
I don't think so. Leverage is several things happened in the U.S. mortgage market that made it fairly resistant to big crashes going forward, and it's not necessarily a good thing. One of them is that the individual homeowners are a lot less leveraged or minuscule leverage relative to pre-2008. So balance sheets of individual households are very solid. Second, the banks don't own as much of the mortgages as they used to own in those days. Most mortgages are owned by Federal Reserve, which is a government entity. and it used to be owned by GS Freddie and Freddie, Fannie, and the banking system. So the government was part of the player. Now government is mostly 100% owner of MBS. And two things changed. The government is not going to be going to collapse as we see in the Fed. No matter mortgage, whatever happens to mortgages, there must have been big decline in market value, but the Fed, nothing happens to the Fed. Secondly, which is actually more interesting and could be potentially my research topic in the future, that the fact that duration of mortgages have increased massively in the last in this Fed hiking cycle. All the duration is held by the Federal Reserve, and this massive change in duration leaves the Federal Reserve unscathed. So is that a good thing, the nationalization of the US?
It leaves them unscathed because they don't suffer mark-to-markets.
That's they don't care about mark-to-market.
Okay, because obviously when you're very long duration, you become very sensitive to jumps in interest rates. And obviously interest rates have gone up. So in theory, if they were a private investor with normal mark-to-market considerations, they'd be losing money, or they'd have to do something to fix the problem. But in their case, they don't have to worry about that.
Hugely. And that's one. Is that a free lunch that you can just rationalize the mortgage market, then provide stability to housing market for decades to come? Because I'm not sure Fed will ever be able to unwind this mortgage book, except a little bit here and there that's running off, actually not much runoff going on. And if the US private sector is capable of taking down that kind of size, that has only window of time that has happened was in the period between 2003 and 2008, where there was quite a bit of private sector mortgage creation, and it didn't end very well. The rest of the time, in the 90s, it was GSEs were the main players, and they hedged the rates quite well, but they didn't have significant, they still pretty much supplied the liquidity to American homeownership, so home prices didn't really collapse. And then now that the Federal Reserve is supplying the liquidity to the mortgage market, it's unlikely for home prices to collapse. So what's puzzling me now, after the last 1 year of interest rate increases and increases in the mortgage yields from 2.5% to 6.5%, that's a massive change if you look in the historical context. So what it means is that large amount of duration changed hands from homeowners, households in the United States, to the government in the matter of a year. That's been happening as the Fed's raising interest rates. So the homeowners then have more capacity to take risk than before because their risk had declined. They just transferred it more to the Fed. And so homeowners can now go and borrow more. I think that's probably what they're doing. They have the capacity to borrow more for more consumption.
And just to be clear, what you mean there is at the beginning, when interest rates were very low, households had a lot of interest rate risk, because there was a possibility of rates going up. But because they refinanced over the course of the last year, they've got rid of that interest rate risk because they've locked into 30-year mortgages. They've given it to the Fed. So the Fed is actually the one with the hot potato.
That's holding the duration risk.
Yeah.
And so Fed's holding the duration risk, a significant chunk of the duration risk that has transferred from households to the Fed. So households now actually, and they may not be consciously computing their duration using some duration calculator, but the subconscious may still be driving. A large number of people may behave more like what the model expects, although they're not consciously doing it, that they see that their risk is low. In their household general balance sheet risk is low because a large chunk has been transferred to Fed. So given that they have low duration in their household balance sheet, they can now take on duration.
Okay. And how would they take on duration? I mean, they could basically take on like credit card debt or take a bank loan out or something, or just take other forms of borrowing on.
They can also do long-term. On the other side, they can do long-term investments on then they take more risk on the
asset side. Okay.
On the asset side, they can buy equities, they can buy the long-term bonds in their portfolio, and that may be keeping the yield curve more inverted than we have ever seen in a Fed scenario.
Yeah.
That there is somewhere, I know in the past, the yield curve was kind of flat when, for example, in 2004, 5, 6, as the Fed was hiking, yield curve was very flat, and we kind of blame the mostly foreign central bank buyers, especially China and Japan, that was bidding on the treasuries, keeping the curve flatter than anyone would expect. Today, it's not only as flat as that, it's way more flat than that. And we know that there is some central bank demand, but it's not that large. It's some Japanese demand, but not huge amount of Chinese demand going on. So there must be some other buyer, something else that causing the belly of the curve to be so much lower and the curve so inverted relative to history. And I think that's maybe because there is so much duration taking capacity in the system that risk taking, even in the face of historic Fed hikes, there's still demand for risk out there, whether it's equities, whether it's tech stocks, whether it's long end of the yield curve. This is a part, and as part of my research topic, I'm thinking about this quite a bit, because where is this? There must be a risk accounting going on in the system.
Yeah.
And the Fed's taking out so much risk, then there must be too many others who don't have enough risk.
Then how does quantitative tightening then fit into this? Because then the Fed is reducing the size of the balance sheet, but is it then that because they're holding onto mortgages and they're just offloading the treasuries, it's the mortgage side actually that has a bigger impact, which then keeps overall yields lower? Because you would have thought if the Fed's now rolling off its treasuries and they're selling their treasuries, or they will, then surely long-term yields will start to go up and you get curve steepening, but that hasn't really happened.
Yes. So the Fed's the mortgage portion is very little. The Fed's reducing the balance sheet, the mortgage portion. They keep saying it, but they don't have a way of reducing the mortgage portion without creating serious turmoil in the mortgage market, in the housing market, and they don't want to take any of that risk. And that leaves the treasuries, and even treasuries, the duration. If you look at the amount of duration that's coming out, if you have to look at it from a cash balance sheet of the Fed, and then there is the duration balance sheet of the Fed. And then there is a convexity balance sheet as well. And let's not go there, but just keeping it simple. The cash balance sheet is going according to plan. It's declining, mostly by reduction in the reserves for the banking system, because the treasury's account is more or less stable. Reverse repo is actually growing, so it's mostly through the reserves in the banking system. That's just the cash. But the duration is also not going down as fast as the cash is, because the small front end is more running off, not the long end. So Fed's doing very little QT in a duration sense.
Okay.
And Fed's doing very minuscule QT in a convexity sense. It's only doing cash sense, and that's what's affecting mostly the reserves of the banking system. And each one has its own separate effect on the financial system. The latter two, which is the duration and convexity, is minuscule. It's only the cash that's declining. So far, the effect of QT is quite small. And so that's the one. And I think it will remain small.
Yeah, and I was going to then ask, given we're in this strange environment, where, as you say, rates have gone up, housing market's not under stress, so we can't use the 08-09 parallel. At the same time, yield curves inversing more than we're used to, at least since the 90s and 2000s onwards.
Right.
I mean, how would you position in these types of markets? We know Dominique, for example, is calling for 8%, which is obviously a very aggressive view. Consensus is more like 5.5% peak on the Fed. But given the uncertainty around the Fed cycle, I mean, you as somebody who's more kind of applied, how would you position in this type of market where you have these kind of almost bimodal or trimodal outcomes?
So my view is that Fed will always do Fed will be the extremely risk averse in this direction of hiking, because they lost so much reputation in hiking too slowly in 2021, or starting to hike so slowly, and the whole transitory versus permanent inflation. There has been a huge amount of dent on the reputation of the Federal Reserve as a process. This direction around, the Fed will, as long as the Fed will just be totally data dependent, and as long as the data is strong, they will keep hiking because they won't be trying to. Ideally, they're supposed to be preemptive, looking ahead a year from now, because these are all lagging indicators, whether it's inflation, whether it's jobs. These are all lagging indicators. If you look at these numbers and making your policy, you are always late. But Fed will have no other choice but to do that, because the pressure of making mistake in this direction is high, but that will actually lead them to make a mistake, in my opinion, and they will overhike than probably is necessary. So I don't know whether it's 8%, 7%, 6%, but overhiking is quite possible. So that
suggests the further inversion then, doesn't it?
It's further inversion. And that suggests that the long end would refuse to follow that. And we see that in the break-evens, the 5-year break-evens, 10-year break-evens are fairly stable at somewhere around 2.25-ish, 2.5-ish%. So the market believes that inflation in the long run will remain fairly anchored, no matter what the Fed does. And no reason to rush to sell the long end of the curve. And then if you look at forget the break even, if you look at the long end real rates, there is still I think that the long end real rate could still be fairly anchored, and it does go up somewhat as soon as the Fed gives a signal that it will hike another 25. Oh no, the peak rate is not 525, it's really 550, and then a few months later we say, oh no, it's 6% or 6.5%. Wherever it goes, the real rate goes up by some amount without changing much of the break even. So I would just buy as these real rates go up. In fact, with this massive jobs data in February, followed by the retail sales and the PCE, it's an opportunity. If you see the real 5-year real rate goes up by a certain amount, and as they keep going higher, you just buy some of that, take a position in the belly of the real rate curve. That's what I would do. It's more like a buying opportunity, and it will eventually probably invert more. But at the end, the Fed will break something. If anyone's thinking that this will be one exception in decades, that Fed ends the hiking cycle without breaking something, no, it's not going to be an exception. It will be, it will end ugly no matter how you look at it. And when it ends ugly, that's when Fed start easing very fast. Every time there's rapid easing, and we'll get back the curve corrects. So all of this action, it'll be in the front end. I will just be in the belly of the curve and accumulate for the mostly, I think, the tips. Because if you believe that the Fed will maybe change its target from 2% to 3% or 4%, which I don't think they will eventually. But if it does, then even then, you have this will help you with buying tips in the belly of the curve, because your carry from actual realized inflation would be very good. So my trade would be just to use these sell-offs as an opportunity to accumulate bonds. Also remember that so much duration is held by the Fed. Private sector duration is not much. So adding duration in the long end is not a bad thing. But the front end is going to be crazy. There will be a lot of volatility and collapses, etc. happen.
So Mustafa, I did notice you said that the Fed, when they hike, they always end up breaking something, and this time will be no different. So what did you mean by that?
I think the Fed's always behind in it's never I haven't seen in my 30-year career in the last 15 to 20 years Fed ahead of the data. Fed's almost chasing, and so what happens because it chases that it goes longer in any direction than it should be. Whether when it's easing right after the pandemic or previously, it doesn't know when to stop. So it goes to zero, and then it finds something new, and it keeps doing it. And especially on the hiking direction, the same thing. We saw every hiking cycle, they keep going until they're gone too far to create a recession or a systemic financial crisis. A smooth exit from hikes, I just don't remember. And this time around, it's going to be even more, because Fed's feeling defensive about making a major mistake in forecasting inflation in 2001. And despite observing inflation, they keep saying it's transitory for at least a year, until rapidly changing their mind. So right now, they are not going to be proactive to stop hiking, even if the data could be for example, shelter inflation has a significant lag, and the lag's a little longer lately than historically from actual new rentals versus shelter inflation. So they would, as long as the data is strong, they would keep hiking, and data we know, because of the lag structure that we have now, that data will remain strong for a while. So they won't stop. They will just keep doing it, and data will remain strong, and they will keep hiking, in my opinion. And eventually, if not, I'm doubtful there will be a liquidity of financial crisis like some of the past end of Fed cycle, like we saw that in the 95, for example, 94, 95, we had all the big crashes in local governments like Orange County and several hedge funds.
And then we also saw the EM crises as well. We had the tequila crisis in Mexico. Then we saw Asia crisis in 97,
Exactly.
LTCM 98, and so on.
The LTCM 98. So they always crashed. Either it's a liquidity crash or a economic crash. And most of the time there is some hidden leverage somewhere that no one knew about, and that basically pricks that leverage.
And let me ask you, I mean, what's the hidden leverage today? I mean, I know obviously it's hard to know that before the event, but if you have to find sources of leverage in the system today, which could potentially be vulnerable, what would you say they are?
Well, we know what's not very levered. It's the households. Households seems to be in pretty good shape, which makes me feel a little better that the crash may not be as big. But the obvious culprit is emerging markets, of course. We already are seeing that it started in terms of with the funding issues, etc., going on in the emerging markets. But I think that people are ignoring the margin compression in corporations. You don't see that in corporate bonds, been doing really well in OAS spaces. High yield is doing really well. IG is doing very well. But if you observe the corporate market for the post GFC, the switch from equity to equity buybacks and replacing with debt has been phenomenal, historic, and the margin compression that's happening now with these robust wages, and also higher and higher interest rate funding costs. It's sort of in the back burner for everyone.
So what you're saying is, profit margins, which have been at very high levels, they're going to come under pressure and start to fall. Partly as interest rates go up, interest rate costs go up, but also because wages go up as well. And then in the end, that could be the thing that cracks the corporate bond market, perhaps.
That seems like one possibility. The mortgage market is highly unlikely because we can talk about that as well. The mortgage market is, in my opinion, is sort of nationalized right now. We got about $2.6 trillion of mortgages held by the Federal Reserve. Another $2.6 trillion of mortgages held by the commercial banks. What's left for anyone else is really small. Maybe $1 trillion or a little bit above $1 trillion is left for the rest of the whole universe of asset managers, hedge funds, everyone else. So we know that this huge increase in interest rates has resulted in significant losses just from the index, at least 10% decline in value. If we look at the balance sheet of banks, the banking system as a whole, you see the mortgage portion of their balance sheets declined by $250-ish billion, and while the Fed's hiking. So Fed must have also lost in that order, because Fed's portfolio is about the same size in similar mix of mortgages. Since they don't report it, we don't know it.
Yeah, as you said earlier, there's no mark to market, so they aren't subject to the same law pressures.
Then I have $250 billion, in my opinion. So Fed's absorbed $250 billion of the loss. Commercial banks, the way accounting works, they don't have to take that loss in their earnings, but they still have to report it. So we don't see that having much of an effect. So $500 to $700 billion loss in the mortgage market hasn't been reflected in anyone's income anywhere. So it's kind of similar. The mortgage nationalized, so the only corporate bonds are still held by real money in a significant way, in real money portfolios and high yield as well. So I would watch out in that as the margin compresses, with successive increases in interest rate, it could come from corporates, it could come from emerging markets. It could be a sudden one instead of a slowly progress.
And you did mention sovereigns, because obviously, sovereign debts picked up, over the years, and at last fiscal deficit after COVID. At the same time, when you look at the yield curve, the curve's very flat, inverted. Measures of term premia, which is the sort of extra amount that investors in theory should demand to hold longer tenors, hasn't really picked up that much, which you would have expected given, the fiscal risk, inflation risk, and so on. Do you think we could see a return of term premia in some way, like a term premia shock of some kind?
Right. That's a huge puzzle for me because historically that's always been a question. As the Fed starts hiking, we saw that this conversation in 2004-5 as well. Why is it that the Fed's hiking and the yield curve is not, yield curve is so flat? There was constant question. I heard that same question in 94. Initially, when the Fed was hiking, the yield curve was not steepening as fast. And the same question was raised when, why isn't it steepening? And then eventually, and it went down to sort of almost zero slope if you look at the 2-cent slope in 94, as well as in 2004, 5, 6, the same thing, it went to 2 cents, went to about zero slope. And then there is always a different answer for why the slope was so flat. In the case of the 2004, 5, 6, it was eventually the story was that there was huge buying by foreign central banks, especially China, and because they were having these huge surpluses in their balance of payments, and so that's causing the yield curve to be so flat. But when this kind of things, when you get the answer by that time, it's kind of late, and that's when you start to see the steepening, either because of a rally in the front end or because of a sell-off in the long end. And in the early 2000s, it was because we eventually cracked the subprime market and the front end rallied and we got massive steepening. But by the time the answer didn't happen, it's already late. And 2004, 5, we saw the same thing, that by the time we got the answer, all this Orange County and all this
in 94,
started crashing.
So today, I mean, what would you say, what's the equivalent of central bank buying in the 2000s that led to a flatter curve? Is there an equivalent today of certain flow that is keeping term premia low and keeping the curve flat?
It's puzzling because it's not as much of the central bank buying, except for probably Japanese, because that's the only especially Japanese private sector buying of U.S. bonds, because the Japanese yields have gone up somewhat, and if you did the yield comparison, it was still very attractive to buy U.S. So if you look at the TIC data last year, that's the only flow that seemed like came out, but that's not large enough to cause the U.S. curve so flat. So one could be just the fundamentals this time is that we were going to get probably coil into a hard landing, and the fundamentals are that the Fed will eventually ease really fast when it gets there in 2024 or at some point. As right now, market is saying there won't be any ease anymore in 2003, which is just dramatic change.
In 2023, yeah.
But 2004 was still a possibility of ease. At that's it could be just the fundamental of the economy is being priced, or it's also possible that so much of the long duration is absorbed by the by players that haven't been in the past in the market, i.e., the Federal Reserve is one of them. If you just look at the Federal Reserve's extension of its mortgage portfolio during this high, it's equivalent to somewhere around 500-600 billion 10-year bill. I'm throwing very approximate head calculation, but 600 billion 10-year equivalent, just the extension of duration of just the mortgage book of the Federal Reserve.
So just explain what you mean by that for people who don't understand how that would work.
Because the interest rates have gone up from average mortgages were like 2.5%. Fed's mortgage portfolio is 2%, 2.5% coupon. And the mortgage rate is now 6-ish, close to 6%. So this increase of 350 to 400% will result in the homeowners, the likelihood of refinancing their mortgages extremely low, causing the duration of the mortgages held by the Federal Reserve and held by the banking system become way longer than it used to be. So currently, if you look at the Bloomberg's estimate of duration, average duration of the mortgage index, it's about close to 7 years, 6.8 years. And it was sort of like 4.5 before the Fed started hiking. So this change in duration for each and every mortgages held by the Federal Reserve and the banking system, because they're pretty much between the two of them hold almost 80% of this universe. So this duration is essentially, this changes duration is essentially for Fed, it's like 500-ish billion 10-year treasury equivalent. It's the same as if Fed just bought another 500 billion 10-year treasuries without actually having to do that transaction.
Okay, yeah, understood, yeah.
So between the two could be $1 trillion of 10-year treasuries that they bought into their portfolios without actually buying this. But there is always an other side of this. Someone else have their duration shorter, like typical homeowner, and now have a shorter bond, which is very long maturity and long duration. So the typical homeowner's ability to buy something else that's long duration has gone up a lot. So if they were supposed to be buying a short-term bond or allocating certain percent of their assets in short-term bond, now they suddenly, in their own household balance sheet, have the ability to buy a longer-term bond because they are short a very long-duration bond to the Fed or the banking system.
Okay, yeah. Now, earlier you did mention Japan, and I know although you tend to focus more on the US, but you have started to look a bit about at Japan. What do you make of the Bank of Japan's chances of lifting yield curve control? So we know in December 2022, they widened the yield curve control band to allow the 10-year JGB yield to go up towards 0.5%. There's speculation now that they could remove the yield curve control, so JGBs could then be flexible and free floating again. What are your thoughts on that?
It's that's a mystery, especially the governor appointee, Ueda, is giving a lot of messages. Everyone's trying to figure out what he's trying to say. My own belief is that they will try to normalize the monetary policy. Because it's too artificial at this point, and then there is some realization on the part of whether there's some structural issues involving the population dynamics, etc., that cannot be resolved just using monetary policy. So my belief is that there will be incremental changes, and whether there will be successively wider bands instead of doing away with yield curve control. I also think that there was some mention of bringing the maturities for the band a little closer, maybe in the 5-year sector rather than 10-year. So we can see any of these happening, but I don't believe that it will be same as before and no change. Because we just started a process in December and abruptly stopped because of the change of the government and leadership. And I think that process will continue, but because of the change of leadership, where that will do it in a way that it doesn't shock the market as much. But it will, because the Japan's influence on the U.S. risk asset market has been very strong at various times in the past, and this will also be very strong.
Okay, now we've covered we've covered a lot of ground, some of it technical. Hopefully our listeners have understood everything and they can obviously rewind and listen again. But I did want to ask you, Mustafa, some personal questions as well. One, and this is I ask all of our guests, is what's the best investment advice that you've ever received from anyone?
Early on, I can't point out an individual investment advice, but the one thing that just a common kindergarten things in finance are the most valuable ones. One of them is diversification, and early on I learned very deeply that since I have taken up a profession which involves fixed income and interest rates and bonds, I will invest in bonds less than a regular person who does work in the bond business do. So I've always, since the early 90s, late 80s, I've always had significantly higher weight on equities and less on bonds, just because I wanted to diversify my career. And it worked out really well over the years. The performance from early 90s to now is significantly higher for equities than bonds. And I always believe that it should be diversifying your portfolio, but it should be diversifying your own skills should be in that basket.
Yeah, I mean, you speak like a true economist there, thinking about yourself as a human capital invested in your career, and you want to diversify against that. So that's very nice. Now, another question, many of our audience are younger, and many of them are at university, final year perhaps, maybe they've just left university and they're entering the job market and they're thinking about their careers, what they should do. What advice would you give to somebody who's leaving university?
The one thing that the advice that I've always given to young people coming into finance, that take more risk with your career. Don't take a job and be too comfortable with your job. Just look to take more risk. Start your own outfit if needed. Change jobs that's riskier but gives you more upside. And don't be afraid of taking worried about downsides, because things that look really negative in the short-term horizon, in the long term, this all washes out. So taking more risk is my consistent advice over the years that to young people that I have met, that I still think that they should be taking more risks.
Yeah, that's great. Excellent advice. Then another question is, what books have really influenced you over your career? But it could be career related, it could be personal as well, even.
Well, there are lots of technical stuff that has actually more influence in me. Things like forecasting, things like on the efficient market. I really believe in when Barton Martell's book on the rapid down Wall Street. I really but recently I just read this book by Alan Blinder, which I think is a must read for any investor, which is let's say the monetary and fiscal history of the United States. And it's sort of a reply to a book of a similar name by Milton Friedman from a long time ago. I've been in the bond market since late 80s, so I know what happened. At least have a decent idea about the policies, monetary and fiscal policies since that time. But prior to that, in the 70s, during the Volcker era, and prior to that, the various Fed policies and the administrations, it's an amazingly clear description of that. And I especially, there's often a discussion of two humps in interest Fed funds rate in the 70s and two humps in inflation. And there's a lots of different interpretations of that in terms of policy. Blinders makes it a really clear description of the change from money supply targeting to interest rate targeting that has taken place at that time. That made it the inflation and interest rate, the double count that they talk about, happen. So I really think it's a must read for investors today. And I really enjoyed it recently. Another recent book I read, and it gets me thinking. It's a book it's called the book called Surveillance Society, and it's by George Chin. And let me give you the. It's a really must read also. It gives it's Surveillance State by George Chin and Lisa Lin. It talks about the proliferation of face recognition cameras and AI across the whole world. Everywhere you go, every country, whether it's Africa, whether it's China, in the US, in Europe, anywhere you go, there is like the constant application of AI and face recognition. So where is it going? What should we be doing as individuals in the society? It raises a lot of interesting questions, provides huge amount of facts from different countries. And then I come to the conclusion, maybe should we just give up and not try to have any privacy, because that's sort of futile. So this is a great book to read, and I had really it got me thinking recently. This book on surveillance state, and both the blinders, both are sort of must-read for now.
Okay, great. No, I mean, I'll add that to my list to read. So thanks for that. Now, finally, what's the best way for people to follow you?
I am in social media. I'm in Twitter. I am in LinkedIn, Facebook. I am also can be reached I'm now at Macro Hive, so I can be reached at Macro Hive as well.
Right.
Chowdhury at macrohive.com.
Yeah, I'll include all the links in the show notes as well. So with that, thanks a lot. It's been a great conversation. I learned a lot as usual, and good luck for the rest of this year.
Thanks, Bilal.
Thanks for listening to the episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a 5-star rating, a nice comment, and let other people know about the show. We'd be super grateful. Finally, sign up for our free newsletter at macrohive.com/free. That's macrohive.com/free. We'll be back soon, so tune in then.